Is it a good idea to have the S&P 500 proxy ETF, SPY, as your sole retirement investment? Is it safe? To help answer those questions, I've prepared a number of illustrations using SPY as our sole retirement investment and spending money under the 4% rule in retirement. I've chosen the years 1994 through 2003 so we can see what happens when you have both good and bad timing. Good timing by retiring during the bull market of the late 90s, and bad timing by retiring in the year 2000 or 2001, right before the recession and multi-year downturn in the S&P 500. Will your money last, or will you run out of money? Can you make a lot of money using the 4% rule in SPY if you have good timing? Let's take a look. Our first illustration will be for a $2 million investment for a retiree who retired on January 1, 1994. They started distributing 4%, growing it by 3% for inflation. 31 years later, they have almost $21 million. This person had good timing, phenomenal growth, excellent inflation protection, and a heck of a retirement by using SPY as their sole retirement investment. Here's the distribution pattern for our hypothetical retiree retiring in 1994, taking out $80,000, 4% off their $2 million, and then growing that by 3% for inflation every single year. This is approximately $4 million of total spending over the last 31 years. If you retired in 1995 with $2 million in SPY, use the 4% rule, you now have $23 million at the end of 2024. Excellent timing, incredible growth. If you retired in 1996 with $2 million in SPY, you've spent $3.6 million, and at the end of 2024, you have $13.3 million in your portfolio. For a retirement in 1997 with $2 million in SPY, using the 4% rule, $9.2 million in the portfolio at the end of 2024. Retiring in 1998 wasn't nearly as good as 97. There wasn't much bull market left, and so the end result was that 27 years later, you're at $4.2 million. You've doubled your money, but you haven't had near the amount of inflation protection when compared to the person who retired 1 year earlier. 1999 was not a good time to retire with $2 million in SPY. You had about 1 year of growth and then a long-term decline. 26 years later, you're at $1.1 million. The year 2000 was a bad time to retire with an all SPY portfolio. Your $2 million was completely exhausted by 2023. 2001 was also not a good time to retire with an all SPY portfolio. By 2024, your $2 million was down to $1.79 million. No inflation protection over this 24-year period. But the big problem you have now is that your distribution is about 9% of the portfolio value. It's going to be very difficult, if not impossible, to grow from here. If we get a recession, it's only going to get worse. The portfolio value will decline rapidly as you continue to distribute large distributions on a declining asset base. 2002 was a much better time to retire. Here we see some losses at the early part of your retirement, but over the last 23 years, your portfolio has grown. You're at $4.5 million at the end of 2024. 2003 was an excellent time to retire with an all SPY portfolio. Your timing was perfect, right at the bottom of a 3-year stock market crash. By the end of 2024, 22 years later, you're sitting pretty with $9.8 million. Outstanding inflation protection. So timing plays a huge role in your success when using SPY or any other all equity portfolio in retirement. I thought it was very interesting last week when Fed Chair Powell made the comment that we have a 1 in 4 chance of a recession showing up randomly in any given year at any time. That means that we have 25% odds of bad timing if we use Fed Chair Powell's math. Now here's an analogy to get you thinking. Let's say you went and met with your surgeon for an elective surgery, and your doctor told you, hey, there's a 25% chance that this surgery could turn out very bad for you. You could have a severe negative outcome. Would you sign up for that surgery? In similar fashion, does it make sense to bet your retirement knowing that you could have 25% odds of bad timing? Something to think about. If you have questions about your investments, please give my office a call. We would be happy to give you a free second opinion on your portfolio. If you like this content, please share it with your friends. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.